Your hard-earned money is slipping through your fingers, but you may not even know about it. Whether you are a beginner or an expert, cognitive biases affect your investment decisions subconsciously in a subtle way. If you reflect back on all your bad investment decisions, you will realize that you must have fallen prey to one of these biases. You may agree or not, but these biases are specifically studied in the field of behavioral economics. So, stay tuned to avoid these mental pitfalls as we uncover 10 cognitive biases and their intricate interplay with our investment choices. 1. Recency bias. You've come across a mutual fund that just had an incredible run of high returns in the last quarter. The temptation to jump on this opportunity is strong, and you're excited about the possibility of making big gains. But here's the catch. You haven't taken the time to look into how this fund has performed over the long haul. This scenario is a classic example of something called recency bias. It's a tendency we humans have to put too much weight on recent events and outcomes when making decisions. So the next time you're tempted by a fund that's been riding high on recent gains, take a step back. Remember that recency bias might be clouding your judgment. Do not forget that strong performance over a short period doesn't necessarily guarantee the same in the future. 2. Confirmation bias. Imagine you're having coffee, engaged in a conversation about investment strategies with two friends. Over time, you've developed a steadfast belief that investing in gold is the most secure option. One of your companions shares this view and passionately endorses gold investments, capturing your full attention. Your other friend passionately argues that bonds are more secure in this battle. Yet, you seem to conveniently hear only the friend who backs up your initial belief. This right here is what experts call confirmation bias. It's comparable to turning a blind eye to opposing viewpoints. The problem is that we conveniently ignore any evidence that contradicts what we're rooting for. And guess what? This cozy little bias we've got going on, it ramps up our confidence to overconfidence, leading us to happily making unfavorable decisions. Before you go all in on a big financial decision, it's a smart move to break down those walls we've built around our thinking. Seek out different perspectives, even if they challenge your comfortable viewpoint. It's like inviting a devil's advocate to the table, someone who will ask the tough questions and stress test your logic. This kind of push and pull can help you see the full picture, not just the parts that match your canvas. 3. Anchoring bias. During a research, participants were asked to write down the last 2 digits of their social security numbers and then bid on various items. Astonishingly, those with higher 2-digit numbers were willing to bid significantly more than those with lower 2-digit numbers. Similarly, in the realm of investing, these anchors often become the highs and lows of the previous 52 weeks. We end up judging whether an asset is a bargain or overpriced based on these anchors, instead of focusing on its actual underlying value. For example, a stock's current trading price is at $40, a far cry from its peak of $60. At first glance, you might perceive it as a steal. 4. Gambler's fallacy. Imagine you're tracking a stock that's been dropping in value over several consecutive days. You start feeling like a rebound is just around the corner. After all, how much lower could it go, right? This is where the gambler's fallacy comes into play. It tricks us into thinking that past events in a random sequence can influence future outcomes. It's like thinking that because a coin has landed on heads several times in a row, it's due to land on tails next. When you let the gambler's fallacy guide your investing decisions, you might end up putting more money into that stock, anticipating a sudden upswing based on a perceived pattern. To avoid this bias, understand past performance does not always influence future outcomes. Focus instead on underlying business fundamentals. 5. Sunk cost fallacy. Imagine you've invested a significant amount of money in a business venture that's not doing well. Despite the mounting losses and the business showing no signs of improvement, you find it hard to walk away. This is a classic example of the sunk cost fallacy. The sunk cost fallacy occurs when time, money, effort that we've already invested influence our decisions, even if the current situation suggests we should cut our losses and move on. It's like finishing a movie you're not enjoying just because you've already paid for the ticket. Your emotional investment won't magically bring back the resources you've already put in. Sticking with an investment solely because of what you've already spent can lead to more opportunity cost. 6. Familiarity bias. Imagine you're at a crossroads, facing 2 intriguing investment options. On one side, there's the well-established powerhouse Nike, a name that resonates with every athlete and sport enthusiast. On the other side stands XYZ Company, a newcomer you've never heard of. But where Nike stock shows consistent return, XYZ holds immense growth potential thanks to favorable new government policies. At first glance, your instinct might lean towards Nike. This is a classic case of the familiarity bias, the subtle force that unconsciously pushes us towards familiar choices. This bias often leads us to associate consistency and security with established giants like Nike. But consider this. Remember how Nokia, once a global giant, experienced a decline while small tech startups emerged as explosive successes? This phenomenon reveals that attributing stability to familiar names isn't always a winning strategy. So remember that security doesn't solely reside in the familiar. 7. Overconfidence bias. Think of biases as puzzle pieces that fall into place when you understand their impact. Imagine predicting a stock's rebound due to the gambler's fallacy, and it happens not once but twice. Suddenly, you feel like a stock market wizard. This is the overconfidence bias at play. However, luck might have played a role in those wins. Overconfidence can lead you to invest heavily in a few opportunities, thinking you've cracked the code and regret later by having all your capital tied up. Just as a casino high can blind judgment, an investment high can lead to regret when luck shifts. 8. Bandwagon effect. You've probably come across this one just like those stories about companies that are supposed to become super successful. When everyone talks about it, you can't help, and the fear of missing out, FOMO, makes you want to jump in, and you do. But then, you end up regretting it and questioning the people you followed. Turns out, they were following someone else too. It's like a never-ending loop. This is the bandwagon effect. This big rush of interest can even make prices go up, like blowing up a balloon. Sometimes big investors intentionally spread fake news. They do this to create a bubble while they secretly sell their own investments before the bubble bursts. 9. Loss aversion. The stock market dips, and you panic and sell solid stocks at a loss to avoid further declines. This demonstrates loss aversion, feeling the pain of losses much more intensely than gains. In fact, research shows avoiding a $100 loss feels twice as good as gaining $100 to us. Loss aversion frequently leads investors to sell winners too quickly and hold losers too long. To overcome loss aversion, commit to a long-term financial plan, and don't let fear shift your course. 10. Framing effect. Imagine you go to an investment consultant seeking advice. He lays out 2 investment plans before you. The investment consultant presents you with Plan A, which he describes as offering a 90% chance of success. Then he introduces Plan B, which he frames as involving a 10% chance of failure. Remarkably, despite both plans representing the same scenario, your unconscious inclination will probably be towards Plan A because of how it was framed in front of you. This is called the framing effect. We hope that your investment journey is full of profit. Here are 3 quick tips. 1. Pause and reflect on your thinking when making financial moves. 2. Seek objective second opinions. 3. Create a financial plan and investment policy statement to guide choices. Like and subscribe for more thought-provoking content.